Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 18th of July 2021. Last week we discussed the features of a crack-up boom. And so this week I thought we'd take a look at the other end of the spectrum and have a look at deflation. Now I'm sure most of you will have heard the debates and arguments supporting the case for deflation. But this is a huge topic and it's too much to discuss in one show. So I thought I'd tackle this by looking at it from one particular angle. And this is one that I haven't heard much discussion about. My question here is, does deflation differ with a fiat currency compared to a currency backed by gold? The purest definition of deflation is a decrease in the money supply. But more commonly, people use the definition of a negative consumer price index. And so this is the definition we're going to use today. Deflation is also associated with credit contraction. And triggers for deflation include reduced government spending or tightening of monetary policy, so an increase in interest rates. These are the standard things that we commonly hear regarding the bad type of deflation. So remember, there's a good type of deflation associated with things like increased efficiency and technological advancements. And there's a bad type of deflation, which is associated with a poor economy. Now, let's look at episodes of deflation as defined by negative CPI in the USA with different forms of currency. When the currency was directly convertible to gold and silver, we can see here that deflationary episodes were very common, occurring in 43% of all years. Now, you can also see that most of these episodes recorded a deflation rate of around -10 here. So you can see these spikes all along here. So in fact, they go below -10. Under the gold standard, shown by this green shaded area, we can see that deflation occurred half as often as it did when gold and silver were directly convertible. And however, the bad deflation episodes did go as low as -10 again. And those dates were in around 1920 and 1930. So just remember those dates as we'll be talking about them next. The next area is this white area here, which is the Fiat era. And it's striking, isn't it? There have been no episodes of deflation in the USA since this time. Let's look more closely at those two episodes of deflation in the 1900s. That is, what did deflation look like when the currency was under a gold standard? This is a chart showing the M2 money supply, and we can see that the money supply dropped by roughly 10% here in 1921 and by around 28% over here between 1930 and 1933. That's a huge drop in money supply. Now let's look at the CPI more closely over that time. Now we can see that before 1920, inflation was actually quite high, around 20%, and it plummeted. So from 1920, it dropped all the way down to just below -10%. So that's a big drop there. It's about a 30% drop if you add it all up together. In 1930 here, though, you can see that it never really got back into inflation, maybe a little bit over here. But then by 1930, it dropped again from 0 down to -10 again. So interesting, the drop there was actually less than the drop in 1920. And that's interesting because the money supply drop was the other way around, wasn't it? It was much larger here in 1930 than in 1920. Both deflations were associated with credit contraction. So on this chart, Credit contraction is shown in blue, and we've got this grey line here, which is the CPI from the previous chart, which I've overlaid onto this chart. Interestingly, in 1920, credit was actually increasing as we were getting disinflation. Then after that peak, that actually dropped quite significantly by about 25%-ish. Now, in 1930, the credit contraction occurred much earlier, and that dropped significantly by about 50% here. That's almost twice the drop that occurred in 1920. Both deflations were also associated with stock bear markets. In 1920, you can see here that the S&P 500 dropped by 28%, whereas in 1929, that saw a drop of around 83%. So that was huge. Now, remember that the amount of deflation in terms of CPI was -10 for both of these times here. And yet the stock market dropped a lot more over here than it did over here. What happened to real estate? Well, shown here are the charts of the Case-Shiller House Price Index, both in nominal terms over here and inflation adjusted terms over here. And I've drawn these thin red lines vertically here to mark 1920 and 1929. In nominal terms, real estate kind of went sideways really in 1920, but in 1929 it dropped about 25%. But remember, that's in nominal terms here. In inflation adjusted terms, we got a different picture. So in 1920, it actually went up about 10% in the index, whereas in 1929, it actually just went sideways in real terms. How about US Treasuries? In the 1920 deflation, you can see here that bonds were actually quite volatile here, but kind of ended up sideways really, didn't it? From 1929 here, bond yields actually dropped from 3.71% down to 3.13%. And notice that interest rates had been rising before that drop occurred. Now, what does that drop kind of equate to in terms of gains? Now, I don't have the data for 1920, but for 1929 and 1930 here, you can see that it equates to around 4% per annum in terms of a gain there if you were in US bonds. Now, that might sound like a pretty mediocre performance, but when you think about it, it was actually one of the best performing assets at the time, particularly given what the stock market had done over here. Finally, let's look at government spending. Now, at the time, this chart basically shows government spending as a percentage of GDP. And you can see that before the deflation started in 1920, government spending rose sharply. It kind of went up like a rocket over there, didn't it? But then it also plummeted. And, you know, that could be one of the triggers for that 1920 recession, is that drop in government spending there. In contrast, just before 1929 deflation, you can see that government spending was actually pretty flat, and it actually only rose as the deflation progressed. Those are some observations of what happened during deflation in the gold standard era. As we saw earlier, though, there are no examples of significant deflation in the Fiat era in the USA. Now, some say, oh, well, deflation occurred in 2008, but the CPI at that time barely hit minus 0.5%. So I wouldn't really call that significant deflation. So I tried looking outside the USA. are there any countries that experienced significant deflation in the Fiat era? So I had a look at this, and the greatest amount I could find was Japan at minus 1.5%. Now, if anyone knows of any countries that have had significant deflation, particularly I'm looking for examples of that are worse than minus 5% even, then let me know, but I don't know of any. Now, to me, that speaks volumes if that is true. As we saw in last week's video, there are loads of examples of countries with inflation and hyperinflation, but none with episodes of bad deflation. Anyway, let's work with the example we've got, and we'll look at the charts for Japan in the same way that we looked at the charts during the Great Depression. So in blue is the CPI for Japan, and in red is the M2 money supply for Japan. We can see here, so for the CPI, we need to use this scale over here, and anything below 0 represents deflation. And we can see that Japan had 2 episodes of deflation, one over here in the late 1990s to early 2000s, and over here in 2008. Now, throughout this whole chart, we can see that money supply has never dropped. It's consistently gone up. It's moved sideways in this bit here, but it's never actually gone down like we saw in the Great Depression. I guess that means that in the Fiat era, deflation can occur without a drop in the money supply, although it is relatively mild, and the deflation would probably be much, much greater if money supply did actually drop. This chart shows credit contraction in Japan during the late 1990s and early 2000s here. In red again is shown that CPI value, just so we know where we are in terms of deflation there. So in this early 2000s, you can see that credit contracted by about 6%. That's much smaller than the 50% contraction that occurred during the Great Depression. Interestingly, in the 2008 deflation, credit only contracted after the deflation had bottomed. So you can see here, it actually started going downwards, but actually that was just reduced growth rather than contraction. The contraction actually only happened over here. Does that mean that credit contraction doesn't always trigger deflation? The Nikkei stock index plummeted in the early 1990s, as shown here. And interestingly, the substantial drop occurred about a year before inflation peaked over here. Now, over this time, from here down to here, stocks had dropped 60%. But over that time, from the peak to that 60% drop over here, when stocks actually just went sideways for a while, that only represents 1.5% of disinflation. And actually from the peak over here, it's even less here. And there's certainly no deflation there. So that tells us that in the Fiat era, stocks can drop substantially without deflation or even significant disinflation. When deflation actually occurred just over here, you can see that stocks actually went up, bizarrely, and then plummeted over here, and kind of the inflation level was kind of flat at that point there. Very strange, isn't it? Real estate prices almost halved between 1990 and 2010 over here, while inflation just kind of oscillated. As we saw in the video from a couple of weeks ago, increasing amounts of printed currency have been going to buy treasuries, keeping bond yields nice and low. In this chart, the Japanese bond yield is shown in red, and in blue is that inflation rate that we were talking about. We can see here that bond yields have just continuously been on a downtrend, regardless of what inflation or deflation is occurring. And finally, this chart shows government spending in Japan as a percentage of GDP in red, and this dark line is the inflation rate. Now, we can see here that government spending has just continued to go up. And that has occurred before, after, and during deflationary episodes. In conclusion, so far, deflationary episodes in the Fiat era seem to have been very mild and are actually quite uncommon. That begs the question, is a CPI of -10 even possible in the Fiat era? Particularly if money supply is continually increasing. Stocks can crash substantially without deflation occurring, and can even crash with minor amounts of disinflation. All the charts we've looked at in the Fiat era seem quite different to those in the gold standard era deflations. That to me suggests that we can't really use the Great Depression as a model for deflation in the Fiat era. There seem to be distortions in the signals. Finally, I want to reiterate that deflation is not the same as disinflation, but more on that next week. Next up, market update. Let's start with gold price in US dollars on the weekly scale. Oh dear, oh dear. Gold kind of reminds me of me in the morning. I'm not really a morning person, and so yeah, gold's kind of behaving a little bit like me, a bit slow to get up really. So this is gold on a weekly scale, and you can see that we've got this indecision candle. It kind of poked up just above that trend line, so I thought things were looking hopeful kind of midweek, but it just turned back down again at the end of the week. So we've got this area of indecision. We can still be bullish because, of course, this line hasn't broken. And, well, let's just see what happens. I mean, yeah, it could come down. Let's look more closely at the daily scale. And it looks like this kind of wedge shape pattern had been forming. We haven't broken out of it yet, but it is moving downwards. I think if we drop below 1800, then I think we've got further drops to come, and the target price would then become around here, 1750. But note that that still doesn't break our long-term bullish trend line. So I'm still not panicking here yet, but just be aware that's a possibility. Of course, we could just turn around because we're kind of where this downsloping trend line is. You know, look, there is hope if we bounce off of that before we get to 1800 and move back up. There is some hope there, but yeah, I think that's really the line to watch for there. Let's move on to the US dollar index, and this kind of fits in with that thing I was saying for gold about another move down, but limited move down. So last week we were talking about this, and we looked at it on the monthly scale, I think. This is just on the weekly scale, taking a closer look. And I was talking about this area here, which is about 93.6 roughly. And I think the dollar, there's potential for it to move up there still, and that would fit in with more downside for gold. Now, there's a few different ways of looking at this, and one thing that people who are bullish on the dollar could say is, well, look, you know, you've got a double bottom here, and if it breaks above that, then, you know, you've got higher targets coming up towards 98. But there are some reasons why I think that's a lower probability. So first of all, this trend line here is on the monthly scale, which we saw last week. And so when we broke down below that, that's acted as resistance. And I think it will again act as resistance. The second thing is we've got this downsloping channel here. And so again, that's likely to form another resistance. And that they both coincide there. And also you've got the top of this here. So if we don't break out above this, which actually kind of meets with this here again, that's another potential reason that it could turn around at that point. So you might get a little bit of a spike up and then turn back down. But that's something worth watching anyway. And I thought we'd have a quick look at the real yield. And what I've done, the real yield is shown in black, but I've inverted the scale. So the real yields are actually negative. So we're about minus 1.75-ish level over here right now. And this is just to show how the inverted real yield has actually correlated quite closely with the gold price shown in orange here. And this goes back to 2018 here. There have been times where they've diverged. So here they diverged, but then gold caught up to it and moved on. And over here, gold actually got ahead of itself and actually went well above the real yield level and then just cooled back down again. So here we had a massive gap, and gold seemed to be starting to catch up over here, but it just reversed again. But that's because the real yield reversed as well. So it seems like from here the correlation is kind of becoming positive again, and they seem to be moving in the same direction. So the big question is, do you think we're going to get more negative real yields? If we start going above these levels here, then I would expect gold to really start catching up to this level over here. Silver, oh, silver. So I think I mentioned, was it last week or a couple of weeks ago, how I'd mainly look at the gold in terms of a break in the trend line. We have drawn this trend line over here for silver, and you know, it may be useful, but the problem with silver is that it can be very crazy. It can just do completely nutty things, and it just messes with you. So it's entirely possible that this breaks, but the gold trend line doesn't break. And so, you know, look, I've drawn it here. Let's see what happens. But if it does break, you know, it doesn't mean it's a cause for panic. It's really the gold one that I'm kind of concentrating on. So yeah, there is a possibility for downside here. We are precariously close to that line there. Let's have a look at what silver has done in the past, where we've got similar kind of triangles here. So looking back, this is from around 2005, and you can see that this triangle was forming, and I'm sure there were similar kind of discussions around that time there. And can you see how silver just poked below that lower trend line there, but it just turned right back around, and look at the move that happened straight after there. So that was a kind of false breakout there. And again, something similar happened here. This isn't quite as a nice triangle on the top here, but yeah, along the bottom, you know, could easily be forgiven for thinking, yeah, this is a triangle. It broke out downwards and we're going to move a lot lower. But it didn't really make the lower target there. Again, it kind of broke down, and then there was another big move up there. So just remember, silver does have a tendency to do these things and mess around with you. So if that line does break, it's really you're watching for gold to break rather than the silver. What about the gold miners? This is the GDX. And well, we've had a big red candle on the Friday there. This is kind of a sideways consolidation here. And the question is, have we got more downside to go? So there are a few ways you can look at this. What we don't want is a break of the $30 level. I think that would be pretty bearish there, because there's actually been quite good long-term support of that. So we don't want to see that. And I've also drawn the Fibonacci retracement here. So I've taken it from the low here to the high here. And I think it's possible for a bit more downside, again, given what we've seen in gold. And so we could well come back down to that around 32.5-ish level. And we've got a little bit of support there as well. Not keen to see it go much lower than that, but yeah, it is possible. I think what we don't want is going below 30.5 really. So yeah, this is quite precarious. I think for the precious metals and the miners, we're kind of at a crossroads now, and a decision is going to have to be made in the next week or so about, you know, whether we're going to be very, very bearish or not. I mean, this could still turn around. As I said, I think there's a little bit of downside, but it would need to start making some decisive moves upwards after that. And in terms of the junior miners, so this is silver. Oh, actually, I've actually got the junior gold miners before we go back to that. So this is the GDXJ on the daily scale. And this had a slightly different way of moving up here. So this looked more like one of those ascending wedges there. It broke out downwards. And the target would be kind of roughly the bottom of this wedge. So there's a tiny little bit more downside, but this is a support zone here between 44 and 41. And preferably we don't want to go below this low here, which is just above 42 and a bit, I think. So we don't want to be going below, much further below that really. But yeah, according to this pattern has almost made its target there. So again, you want to really be seeing a turnaround at that point. And then the silver miners. Now, talk about sweeping the leg. I thought we were supposed to be doing the sweeping. Anyway, we had the leg swept on us. That line broke. We've been talking about that line for ages, and for a long time, you know, price bounced off of it. We got all these wicks hitting it, but no kind of solid candles, and we got a real solid red candle over there. So that's not a great news, is it? Look, I think there is still more downside. Remember, silver is often it is a lot more volatile than gold, and the junior miners are even more volatile than silver. So you've got to be able to take the volatility, and the volatility can be harsh. At the moment, we're close to that 38.2 retracement of this whole move over here. So sorry, from around March last year. And can it go further? Yeah, I think it can. If silver does drop further, then I think we're looking at around the 12 level now. There does seem to be a fair amount of support here, and even going back further. And that's a 50% retracement level as well. So that is a possibility there. We just got to bear that in mind. Now, of course, you know, we could be lucky and it could just stay up to the 38% level. And if we get a green candle coming back up here, then I think that's going to be hopeful. That could just basically be one of those false breakouts that I was talking about earlier. Of course, we had a false breakout over here and here as well to the upside. So there's no reason why it can't happen in either direction, but it just makes it really difficult to kind of get a grasp on what's going on. Yeah, I'm afraid I don't have the answers for these things. You know, if I did, I think I'll be sitting somewhere a lot warmer and a lot sunnier right now. Yeah, anyway, yeah, there's a lot of uncertainty. I wish I could tell you what's going on, but I think in the big picture, I'm still positive, I'm still bullish, but you just got to be able to weather some of these you know, some of this thrashing. It's a bit like being on one of those bucking broncos. Okay, and the other thing I looked at was in terms of the silver miners. I tried looking at this volume by price. I still haven't completely sussed this out yet of how really we can use it. But it seems the most volume was traded over here, just below kind of around 15.5-ish kind of level really, and we've dropped below that. So now this is a bit of a worry because I think at the moment we're around here, and below that there's low volume, and the next kind of support in terms of volume is here at about 12. So that fits in with what I was mentioning in the previous chart. So if we drop below here, then I'd expect a swift drop to 12, just because there's not much volume over here as well. And also there's not much price action. If you look here, there's much more coming up towards the 12. So either we want to see a quick turnaround and move up. If it doesn't do that, just brace yourself, basically. Okay, and I think we'll end with kind of carrying on from our discussion of art that we've had at the end of some of our shows here. So I wanted to talk about a piece of art that came up recently. So in New Zealand, we've got a population of 5 million. So I'm sure many of you live in cities that are bigger than that, let alone, you know, let alone a whole country. Anyway, we've got a central bank that's recently decided to buy some art for its lobby, and they paid 400,000 New Zealand dollars for it. And so in US dollars, that's about $280,000. And as far as I know, I think it's publicly funded. And anyway, so I just wanted to show you that piece of art, and it'd be interesting to see what you think of it. Okay, fanfare. Right, anyway, no comment from me. If you like this show, press the like button. Don't forget to subscribe if you haven't done so already. And we shall see you next week. Hopefully we've got better news for you next week. Bye!